as well. So, all right, let me get started. All right. So, hello everyone. My name is Aaron Goins, and this is the All In on Real Estate Meetup. We're here every Thursday at 7 p.m. The reason why I started this meetup is because when I was in the military, no one in my circle talked about real estate. They all talked about saving money, TSP, stocks and bonds. And a lot of times when people deploy, you see a lot more Dodge Chargers pickup trucks on the road than appreciating value items like real estate. So I want to create a meetup that is educational, that everybody can learn and learn all the nuances about real estate so they can build generational wealth for themselves and their families. So I am very, very excited for our guest speaker. Um, a little bit about our guest speaker. The reason why I have my meetup is because I loved her meetup so much that I started my own. I love her concept, and even this concept of this meetup now is because of Julie Ann Peterson. So, um, Julie Ann, thank you so much for coming. And we don't really have anybody new today. I knew some people were going to come on a little bit later,
Yeah.
but we can get right to you. But can you please introduce to everybody who don't know you? I think everybody does, and then let's rock and roll your presentation.
All right. Well, of course. Thank you so much, Aaron. I always love to be in your presence. My name's Julie Ann Peterson, and I am a senior director at Old Capital Lending. We are a premier provider of commercial debt. So that is all of the different commercial asset classes. So you've got, and I'm going to go through this a little bit more as we get into it. But if you're looking at anything that is, won't take a commercial bank loan, we can help you. Bridge, bank, agency, CMBS. We don't do hard money, we don't do private lending, but a little bit about me is that I am different. Most of the brokers that you'll find, and we are a mortgage broker, so we come with lots of different abilities to get the transaction done, because you go to one kind of bank or one kind of bridge, and if they can't get it done, you're stuck. So you come to a broker and you can have all different options. So myself, different than my colleagues at Old Capital, because I've been in your shoes. I have purchased commercial properties before, and I've gotten the, oh, go away, you don't know what you're talking about. So when I got into commercial lending, I said I did not want to leave anybody behind. I wanted to be able to help as many people as I could, especially new people, because that's where your growth starts, is when you don't know anything. I can infuse a little bit of knowledge into you, and then you can grow and expand into great things. So love to have the opportunity when you've got less than one to go over the details of commercial lending, and then I can help on providing a sponsor, providing a attorney if you don't have one, or an insurance broker, any of the your teammates I can help you with. So not typically the way that most brokers will work, but I do see that there's a lot of value in helping to create a team together. Um, I am actually located in the great state of California, and nobody said that, and I don't say it much either, but it is something that, you know what, I don't do uh, my commercial business here. I go outside of this great state. So we're nationwide. We have been in business for 35, 36 years. We've closed 5,800 loans. And by that is a lot of loans, especially in commercial. We got really started in a lot of our multifamily when we went in 2008, 2009. And that's when we saw a lot of agency, the Fannie and Freddie coming to the party. So we do agency, we do bridge, we do CMBS, which is commercial mortgage-backed securities, as well as bank financing. I've been in the business for 30 years. I've been a landlord for 21 years, and I am done. I am no longer going to be a landlord. I'm closing my last property that I own the end of this month. So I'm super excited about that. I have developed our own Zoom at 8. We've been in business at Zoom at 8 for over 2 years. I am an advisor on the Michael Blanc group, and we started it there and thought that it would be great to, again, offer the ability to get deals done. Nobody else over there was getting deals done because if you weren't in the mentor program, you had to bring the option to the Michael Blanc group, and they may take it, they may not. So I said, let me help. So Zoom at 8 has been great for building relationships. You're always welcome. It's every Tuesday night. We have big speakers. Here is Keith Weinhold. It took me 2 years to get him on, and he's, people like this are creating value for my group. You can find us there making some silly faces. We have a great time and learn a lot. Old Capital is also very well known for our podcast. We want to educate, like in Zoom at 8, when we're bringing great topics. We also do the podcast. So Paul Peebles is our national director at Old Capital, and Michael Becker, who used to work for a large lender, now is off, has 10,000 units. And these two talk to regular people, regular real life investors who are talking about, what do you do when you have a fire at closing? What do you do when you need to fire your property manager? So tune in, oldcapitalpodcast.com. You'll learn a ton. The other thing is we also do in October, the Old Capital Conference. We've got great speakers, but this is the place to find your teammates, whether it is an attorney, you've got other partners there, brokers are here. This is one of the top conferences to go to. It's about $400, and we are creating lots of value and learning experiences in these. So these are what as I mentioned, these are the different asset classes. I didn't put in senior and student housing because, quite frankly, they've been pretty quiet in the COVID, but you can see across the board, and our focus is really multifamily, that we can do. There's all different options, and we do carry most of those except for the private lenders. You all know what this means, and you know how it has affected your daily living. I haven't left my house in days, weeks, months. It's created lots and lots of change for me. It's created a lot of changes for you. Not only great, some difficult, some terrible stories. God bless Trevor's sister. But you know what? There is some good that has happened. There's a lot of money out there, and there's a lot of people that want to invest in these deals. And maybe one of them is you. So you got to know what's going on in commercial lending. So I thought I would kind of give you a market update and kind of talk about what the direction is right now in getting deals done in multifamily. So the top 3 items are jobs, growth, and collections. If you've been underwriting, you can find deals that are 90% occupied for 90 days. But if you look at the collections or you look at the bad debt, it is truly affecting these transactions. We are still off in our jobs, as you can see over on the right-hand side. Right when COVID hit, we lost millions of jobs, and we've created some, we've gotten some back, but no doubt we still have 9 million people out of jobs. So it is truly affecting what's happening in the marketplace. Rent growth, everything you hear it is growing. If you talk to some operators, and we try and keep track of really what's happening out there, and there is some negative rent growth. So don't overlook those. So some of those struggles, right? A lot of these in the Sun Belt or the Smile states are still experiencing very challenging times. And when you get a tenant that is taking advantage of some of these programs, yes, they're out there for them to take advantage of, but once you get that in your, that gets into your community, it's hard to get them to pay or to get out. So be aware of some of the challenges that is creating. And obviously with collections on the eviction process, again in California, it can take us 18 months to get somebody out. So be aware of those local issues and how the courts are handling them. You can certainly see in this bottom view just the velocity of the loss and the creation of unemployment. It's creating unemployment and employment. So the stimulus package, it has been helpful to so many so that they are buying new cars. New car sales are up, and the landlords are not getting paid. So don't think that everything is all great and wonderful, because behind the curtain, there are some struggles. We see GDP growth between 6 and 8, and right now it's at 7. So they are consistent with that statement. Now, this guy, everybody puts their belief in him, and I would say this can go both ways. They're saying we're going to keep inflation at a minimum. We were told that over the next 3 years that the feds are not going to raise the rates. And I will tell you, and we'll take it further into this presentation, that things are changing. And so you need to be well aware of that. So tonight I wanted to talk about 3 things, what you're seeing. We are seeing a big difference in Freddie. Really it's the adjustable rate financing. We're looking at Fannie conventional, the agency debt on the conventional side, which is 6 million and up, and then bridge, really big difference. As you know, COVID, created a real big mess, and we'll go through that as we make our way through this. But last year, you can see that quarter over quarter, we've got growth in multifamily using agency debt. Even though we shut down for like 6 weeks, the majority of the business was an agency. So that's great. We love to hear that. We love those loans. Fannie and Freddie are doing great things for affordable housing. We also see that this growth is going to continue here in this Walter and Dunlop. They're a broker like us. They're continuing to see this growth be on a great forward trajectory. But you have to look at the reality of what's happening behind the scenes on the 10-year treasury. That is what drives the 10-year treasury, drives the agency debt. Okay, so I wanted to show this to you. You can see here March 2020 how it hit the ground. We haven't seen rates that low. I mean, just incredibly terrible. And then we had some spikes, but all along it's been slow up until January. Things started to take off. And it's something to be aware of, because when you're sizing some of these and you're modeling them, they're not working. And they're not working for a couple of reasons. And one of them would be the 10-year treasury is changing the rates. Here's an example. January 11th, we can see 3.27 on a 10-year, I'm sorry, 7-year, and then 3.18. You can see those are fairly low rates, but as you can see, 2 months later, we've got an increase in the 10-year treasury, which we were told was going to be flat. And by the way, it has increased 50 bips, 50 bips over the last 6 weeks. However, I just got a decrease of 10 bips Monday or Tuesday. So I think we're going to see this fluctuation for a while, and potentially it's just going to depend on when you lock that in, what that rate looks like. Now looking at May 19th, we're looking at 3.85. So that is a very large 60 bip change in a very short amount of time. Conventional Freddie. Okay, so Freddie it's a floating rate. And this has been a great product recently. Freddie floaters were not doing great up until probably, I'd say November. And November kind of opened up and said, hey, this is a great option. So if you look at this, SOFR and LIBOR are another index that we use for this type of lending, as opposed to the 10-year treasury. So in January, we had rates of on the interest rate is 0.09. When we look at March, it went to 0.02. So very big difference in those 2 months. And typically, these SOFR and LIBOR, there's not a lot of decrease or increase. It's very slow, very minimal movement. But what's happening, what we're seeing is this forward curve where we thought over an 8-year period on the top here, over the 8-year period, we were going to see it rising. This is what we were talking about, that we would actually would take that long, 8 years, to get SOFR to 1%. Right now we're at 0.09, 0.09, 0.16, something like that. Well, it was going to get to 1.0 in 8 years. You can see in this top. But on the bottom, it's showing that actually it's going to be moving faster. And in 2023, which is only 2 years away, we're going to be at the same spot that we thought 1% was going to be in 8 years. So with that said, these Freddie and bridge loans are attached to that index. So what is happening now is that what you have to do is have a rate cap. If no one's ever told you about a rate cap, it's time to listen up. These are like an insurance policy. So, when you've got, back in 2008, a lot of people went into these adjustable rate mortgages, and they were saying, that your value was X, and they were paying way over price, so they couldn't make sense of it, so they just walked away. These rate caps are helping manage your business with the interest rate. So in essence, if we buy one of these, whether it is a Freddie floater or it is a bridge loan, you have to buy this insurance policy. So if you buy it at 4% today, and we buy a 2% strike, and if you can look here for 3-year on this first one, these are 1% strikes. They come in 2%, they come in 3% strikes. This one is a 1% strike. So that means you bought it at 4, it goes up 1% to 5, you still have to pay that rate. You have to pay the difference, right? From 4 to 5, you're going to pay that mortgage difference. But once it jumps over 5%, let's say it goes to 2% at 6%, right? You have this rate cap, this insurance policy. It's going to protect you, and they're going to reimburse you for the difference between the rate of 5 and 6. But here's the kicker. Don't forget this information, because you do need to model this when you are getting a quote for bridge. And a lot of times when you talk to me, I remind you about this. But if you look at on the left-hand side, 12 months ago, this rate cap cost $70,000. So bridge 12 months ago in COVID, there wasn't a lot of bridge going on. So it cost $70,000 because we really didn't know what was going on. 6 months ago, bridge lenders are coming back. That rate cap price to buy this insurance policy was $35,000. And then it dropped a little lower, because remember, I showed you that went from 0.9 to 0.02. So the rate cap dropped because the certainty that the rates weren't going up, we had enough certainty, we were told this is not going to be changing, then the policy was cheap. But today, because we're looking at that forward curve and we see that happening, that it's going up, this rate cap is now $135,000. This is a lot of money. Look at it, 2, 68, and 3 is $52,000. 3 months ago, when we were starting to see bridge, it was cheap to get in. And I will tell you, as we get closer to seeing these rates go up on SOFR, these are going to get more and more expensive. So it's making the decision to go with a bridge at the right time, or then switching over to agency. And so right now it's a great time to be looking at doing bridge lending because of this. Okay. Number of bridge lenders that were before COVID, and when COVID, look at this, everybody disappeared. Those lenders that were on board, that were doing loans in 2018 are probably not the same lenders or have the same amount of cash that they're bringing to the market. They're not the same ones. So basically these lenders, they get money, they securitize it with bonds, and they have a bunch of cash. Then they give it all out. They go back to the drawing board, get more money, they come back to the market. That's basically, in a roundabout quick way of looking at it, that's how bridge lending is. Any of us could be bridge lenders if we had a bunch of money. And you could come to the market at 3.5%, 3%. I mean, I'm seeing deals at 3.5%, 4% in major markets, plus 100% of your rehab dollars. I mean, you can't do that in agency. And on top of that, when we go to agency, you have the COVID reserves, and we're going to talk about that in just a minute. And so this is just kind of a graph to show you where the rates were. And when COVID came, all of these guys, they could not secure these loans. They didn't want to stand behind them because nobody knew what was going to happen. So they jacked up their prices. Very similar to what happened with the agencies. We kind of put ourselves on pause for about 6 weeks until we could figure it out. But as you can see, over the months that they've come back and returned to the market, the rates are incredibly low. So I want to show you this very valuable breakdown. This is on a $30 million deal. If we look simply at Fannie, you know, great lending. Everybody wants Fannie and Freddie lending. You can get 80% loan to value in major markets at 1.25 debt service. These are the gold standards. So on that $30 million deal, I'm going to give you $21 million. You're going to have yield maintenance. It's all going to be kumbaya. Everybody's going to be happy at 3.5, 3.75. Now, remember, you do have those COVID reserves, which are going to cost you probably another maybe 750,000 that you're going to need to bring in from your lenders. I'm sorry, from your investors. So you've got that extra debt service that you need to put in an escrow, as well as you need to capital raise your rehab, which could be another $1 million. All right. Next option would be Freddie. Freddie is that Freddie floater. So actually, Freddie said, because of the volatility in the market, not sure how fast we're going to move on these, they've brought it down. Instead of 80% in that same market, they're now going at 65%. And remember, when you're choosing which loan to go with, a lot of us are going to be looking at the most amount of loan dollars, because capital raising can be difficult. So that's one of the key points when you're considering which loan to go with. It's typically the most amount of loan dollars. So in this case, you're at 19.5 versus 21. So you're a little bit off there. We're still, 3 to 5 with interest only, just like Fannie. we're at the same debt service, but on this one, you've got to have that rate cap. So that's another, let's say 100,000 at this rate, at this 30 million, it might cost you $1 million, 100,000. All right. So you have to think about that. They also are going to have your COVID reserves. So, and you have to capital raise again, your CapEx expenses. So let's look at the other reason why you'd want to go with the bridge. So same 30,000, I'm going to give you 75% loan to cost. And that's going to give you either 75 on a loan to cost, or I might even be able to get you to 100% of your rehab dollars. Huge difference. So your loan dollars are more like $24,000 on 30,000. You only have to capital raise 6 million. I mean, it makes these big deals a little bit more achievable. All right, but you do have to think about what's going to happen in 3 years. Where is the market going to be? A lot of us forget that you have to sell this or you have to refinance it. We don't know what the cost of funds will be in 3 to 5 years. So you always want to be making sure that you've got somebody experienced with net worth, with liquidity, and the experience on your team when you're looking at bridge. And these lenders want to see that up front. They want to know what the risk is to them. If something were to fail, they're going to have to take it back. They want to minimize taking back these transactions. So this is just a real quick overview of those COVID reserves, where we've been and where we are now today. Now, there has been some updating to this, but just from a high level, if you look at Fannie, you're at 12 months on transactions that are 3 million and above. That just changed about 3 weeks ago. Maybe it was February. It used to be from 0 to 6 million was 18 months. Now we've brought that down to 3 million, and then below 3 million is going to be 18 months. And then for the Fannie small balance, depends on if you are 25 or 75% or 80%, which tier you're in, on how much of the COVID reserves you are required. But here's the update. So on transactions 3 million and above, if the transaction, if the opportunity, if the building has minimal age receivables, and then collections, the rent collections are stable, they will open up the idea of taking a waiver. And a waiver is something that's above and beyond what they're doing now. So if it's performing well and you're above, let's say you're at an 80% loan to value, we would give you 6 months. We'd actually require you to bring 6 months of interest only, not principal and interest, just interest only on that 80%. When you go below into the 65 range, we can basically on these waivers have you not have to bring in any COVID reserves. So that's new, that's pretty cool. Not going to be available on your senior and student housing. But I would not size these with these waivers. These are kind of your whipped cream on your sundae. If it works out, great, but I would not adjust it with the assumption you're going to get that. Looking at Freddie, really these guys are 12 months, whether you're in the large balance or the small balance. The only change that really took place is they went from a 145 on debt service to a 135. So not a big difference on the Freddie. When you're looking at how you're putting debt on these assets, you have to think about what is the risk factor to your investors. So putting simply on Fannie and Freddie, we see that as a little bit riskier than, let's say, obviously your cash and maybe even on a bank loan. When you get into agency, non-recourse, for the returns that are available, pretty even on the risk factor. But once you push into this bridge or the Freddie floater, you're getting into a little bit higher risk. So you do need to visit with your investors and what is their risk tolerance? What would they be interested in, especially if you're looking at some of these assets that need some CapEx? How much are they willing to risk losing? All right, does anybody have any questions before we go into the details of what it takes to get one of these agency loans?
Can I ask a quick question? It's Greg.
Sure, yeah.
All right, so the rate cap, the way you explain the rate cap and using the term strike, it sounds like an option, I guess for
Hedging, kind of like a hedge.
and hedging, these kind of things.
Yep.
Is that
Yep.
is that what? Okay. All right. So and so wait, then what factors actually what factors influence that hedge? Is it
Well, you would say that the longer you go out, there's more of a it's what's the word I'm trying to find?
Extractive factors or time value?
Yes, but really it is proposing that what we really, it's all speculation is the word I want to say.
Mm-hmm.
It's speculation. So these guys don't want to speculate. They'll speculate, but they're going to charge you for it. So when you get
Mm-hmm.
into like a 5-year, that's all speculation because they don't want to tell you in 5 years and charge you not enough because that's a risk to them. So you're basically saying, I'm willing to put in the risk and I'm willing to pay for it because I don't know what's going to happen in 5 years. You know, economists like to stay close. We can look at what's happened in the past, but we'll take the risk and we'll provide this service for you, but only for a 2 or 3, even 3 years, it starts to get a little bit more expensive. That's how much they're willing to put their neck out for this speculation.
Okay, thank you.
Yeah. Anybody else?
Yeah, I have one question, Julie.
Sure.
First, have you seen, like, with the loans that happened last summer that had the year reserve, any of those being released? And second, as an LP, if I see a presentation where they're assuming or planning on at year one, like the reserve requirement going away and using that money to fund CapEx in year 2,
Yes.
Is that like a red flag or is that a valid assumption?
No, I've seen that a lot. And I think that is a valid assumption. I have not, I've heard people are getting their returns back. In fact, in Freddie, it says that if you have 9 months, you can start to ask for it to be returned. If they see a quarter that you've had growth, income growth, or even being stable, they'll return them. And so we are seeing a lot of those being returned or even utilizing them for their CapEx. I think at first, when we first went into COVID, nobody was really thinking about that. So they brought in their CapEx. So they're just being returned now because we're really, a lot of these loans, we went back in like, let's say May. So we've seen the majority of those early ones are still in the process because let's face it, it got bad there for a good 6 months. And I think you're going to start to see more and more of that. We're just on the cusp of the returns right now, but we have seen some returns. Anybody else? Okay. There may be someone in the house that doesn't know this, or you guys need a little bit of a reminder. So when we're getting into agency, and I love agency, and I've said that on this call because it is the gold standard. Before, only the rich people could buy these assets. Now you and I can buy these assets because it requires 4 things. 1, 90% occupied for 90 days. Now again, there's 90% physical, and then there's 90% or less economic. We're going to take into consideration 85% economic. We're going to work through those numbers. We're going to try and understand them. But for the most part, we're looking at 90% physical occupancy. The other 3 key pieces are important for you to understand what you need from your group, from your team. You cannot do this alone. So you need net worth greater than the loan amount. $10 million deal. When you get into a $10 million deal, you have to figure out how much money do I need to bring. This idea of I can use other people's money is very interesting. You still have to have money in the deal. This net worth at 25%, or rather 75%, I'm going to give you $7.5 million. You need to have net worth of $7.5 million. Now that can come from one person. It can come from 4 people gathered with all of their net worth. But going out and looking at 500 unit buildings and you have 0 money, I think is difficult. You really do need to make sure that you know exactly where your capital is coming from before you put yourself in those deals. Third piece is your liquidity. I need 10% of that loan amount in cash. So again, when you're building this team and you're going after this $10 million deal, somebody on your team or collectively has to have $750,000 in the bank. That's can be difficult to find. Not everybody, I really see cash as being like crack. When you have it, you want to spend it. You want to buy more real estate. So you have to find somebody that values the idea of having liquidity, and they're few and far between. So you got to find them and get them on your team. The last piece is experience. I'm going to look for 2 years of multifamily agency debt experience. Now, if you have 500 units in single family and you're going for a 100-unit multifamily, I'm going to take consideration that you happen to know what you're doing in real estate. But if you have 5 units in single family and you're going for a 100-unit building, I'm going to say you're probably not going to use that experience in single family for this asset. Okay, so be thinking about where are you going to find this experience. This person or your group has to have 3 to 5 transactions. So be on the lookout for these guys. So with that, all those elements put together, we can get you a loan. Now, Old Capital has been known for execution certainty. What does that mean? That means that I know if I get into a deal that we're going to be able to close because I have put together your personal financial statement. I've collected from your group personal financial statements, a schedule of real estate, we call it an SREO, and a resume. If you don't have these, you need to start working on them today, because you don't want to be working on this when you have a deal and you need to get this to your lender. The sooner you put this together, the better you will be. And you put yourself in these Zoom calls and in this community, no doubt you're going to get into one of these deals, and be prepared. So have those. It's really, really important. So you may be asking, what do I do now? What should I be looking for? And is it the right time? Today is better than yesterday, and probably maybe better than tomorrow, because you don't know what tomorrow's going to hold. So today's the day. Get prepared. There's acquisitions out there. There's opportunities to refinance what you already have, or get into assumptions. Assumptions can be amazing if you find the right opportunity. I've closed assumptions. Old capital helps because let's face it, if you've never been in a deal, you don't know what is required. So don't say, well, I'm doing an assumption, I don't need you. Old capital can really help hold your hand and guide you. With these assumptions, keep in mind, these are people that purchase properties and probably didn't think about the product that they were buying or the business plan. So not that it would be a punishment, but I think that there are opportunities where you could find some owners that need to get out and offer them an assumption. And I've been, like I say, I've been in deals where we were assuming a property that's at 113 and we were getting it for $83. So you can find these deals where these buyers just want to get out. So maybe look at that as a strategy. We need to know our market. And I will tell you that you don't want to put, I always find it interesting when I ask people on my Zoom at 8, where are you looking? And they go through the litany of 25 different cities. You cannot become the person in the know in all these different markets. Be the person that knows everything, that is creating values for other groups in 2 or 3 markets. Know the plumbers, know the roofers, have the relationship with a contractor in those markets. Know who the owners are and who will maybe be bringing you deals after you have 1, 2, because this is how it works. They see what you're doing and they say, I want to get out of this and I'm bringing it to Steve. That's how these areas work. But if you're only there with 1 deal, they don't know who you are, but they see you there with 2 or 3. Now opportunities come to you just since you're there. The tenant base is huge. Macon, Georgia, Warner Robins, Fayetteville, North Carolina, Houston. A lot of these markets are pre-review cities, and a lot of them have military component to them. So if you're going into those markets, agency doesn't really like where we've got a huge concentration of one kind of, whether it be the military or a company. Houston used to be huge because they only had one employer, oil and gas. Over the last 10 years, as everybody knows, they've really diversified. But you know what? They're still on the pre-review list with these lenders. So you got to find out, okay, where is the best place for me to put my cash if you're an investor, or where should I be buying so my investors will be attracted to that area? And military, unfortunately, can be a stumbling block. Survey your investors. If you're getting into this deal and you are going to Arkansas and none of your investors want to go there, I would highly recommend you know that before you go get into a deal. All you have is your reputation. So if you're putting in LOIs and you're putting them in, you're getting into them and then you figure out after a week you've done the underwriting, it doesn't work, that's going to sting your reputation. You do that in a couple different times, you can pretty much pack your bags and go to another market. So my recommendation is always go to a market that you practice in and then go to the market that you want after you've learned that when a broker says, I need proof of funds, you say, you don't know what you're talking about. Of course, you wouldn't want to say that but you'd want to say, you know, this is, I'm syndicating this. I don't need proof of funds, you know. So knowing that stuff in advance, you can learn this and then take it on the road. You keep in mind when you're doing this, we've got these reserves still in place and they are affecting the returns. So which product is best for your transaction? And I am certainly happy to jump on a call to figure out what it is that works for you. And I would say if you're looking at the market today, I think it's going to be a lot different in 6 months and even a year. So be thinking about what opportunities may be there in 6 months or maybe a year. I really believe that a lot of people got into this 18 to 24 months ago that said, I have to have 1,000 units by Tuesday. And I think those guys are hit with the evictions and the moratoriums, and they're finding themselves that their bank accounts have no money in them. And at what point is that sustainable? It's not, and they're looking to get out fairly quickly. So I think around the corner, we're going to see some deterioration. And I can tell you this, we are starting to see capital calls and infusion in cash from some of the investors. So I think people have some pride, and they don't want anybody to know that that's going on. But at some point, that can no longer happen, and those are the deals that you want to look for. Is there any questions?
Wow. Wow, wow, wow.
I was going to ask, for the personal financial statements,
Yeah.
where do we get a template, especially as newbies? It's my first time, admittedly, hearing of that. So where do we get that to be fully prepared?
So you can go online and just, look up blank personal financial statements. I can probably, if you shoot me over your email, Gregory,
Okay.
I can, or Greggy, I don't know if you knew that, it's Greggy.
I know it.
I like it. I can send it over to you, just a plain one. It doesn't have to be exciting or pictures and everything on it. It's just plain. Start to look at that. And, as an investor, if you're investing in, your LPs, it's great to see the values go up. I would caution you, people will put in 100,000 or 50,000 into a $100 million deal or even a $10 million deal. You put 100 into a $10 million deal, you're not worth 10 million. I know that's hard to believe, but you're only worth that 100,000 until the value of that asset goes up. Now it will go up. I say you change it yearly when you're an LP. I have recently looked at people's personal financial statements, and they have, I'm worth $35 million. They're in 10 deals, but they only put in, maybe 250, but they're worth 35 million. So be aware of how we look at that. You are only the shares that you own on that one transaction. But as they improve, so does your net worth.
Thank you.
Yep.
Hi, Julie. It's Mona. How are
Hi,
you?
Mona. Good. Good to see you.
You too. Quick question. You mentioned looking for the assumption possibilities with some of these properties.
Yes.
Where would be the best place to really try to find the people who might be willing to assume? Or is it just a bunch of cold calls and just contacting people, or is there another avenue you would suggest to look for these?
Yeah, of course, brokers are going to have that opportunity, but I do believe that the real opportunity is going directly to some of these guys where, maybe you've seen the asset in your local area go down. And that might be an opportunity to go in and just say, hey, have you thought about maybe I can assume that loan? I would, Yardi Matrix, you can get a Yardi Matrix and you can find out what bank or what the lender is on that deal. And so I would be looking at any of the DUS lenders that it'll say Fannie or it'll say Freddie on there. And if you're, what would be great is if those, you're looking at Fannie or Freddie loans to assume. That would be your optimal. That's a little bit strategic and it takes a little while. Get a VA, maybe they can help you with that. Yeah.
Okay.
And by the way, I was talking about you with a gal named Sia. I don't know if you got her contact. We were trying to kind of put you guys together. She's in Baltimore, I think DC. So she's looking to do some deals. And I said, oh, you got to talk to Mona.
Oh, well, thank you. I've not spoken with her yet, but
okay,
we'll try to find her.
Okay.
Thank
If
you.
I've got her email, I will send it to you.
Okay, awesome.
Hey, Julie, can I ask a follow-up to that?
Sure. Do
Like,
you want to talk to Sia too?
oh, no.
Oh, okay.
Just when you're researching loans, is there any way, or is it public information what the either yield maintenance or prepayment penalties are? So you sort of use that as a like a negotiating tool, like if
Yeah.
you, or
No, we don't make that public, and nor do we make public the defaults or capital calls or anything like that, or forbearance. There isn't a public record for that, unfortunately. I think it's more of, spray and pray. Unfortunately, it's a lot of work. But if you're in that market and they constantly are seeing you come in and contact them, at some point through your creativity, you're going to get somebody that's going to be talking to you, wanting to hear what you have to say.
I have a question.
Sure.
So for smaller loans, less than 750,000, those are bank loans, right?
That are under $1 million?
And less than 750,000.
Oh, okay. So you're going to be looking at a bank loan. You could be looking at a bridge loan if there's a CapEx component to that. It could be hard money, could be private money, but typically bank or even like a credit union.
The rates overall are going up, correct? Like I think I'm in my Facebook group, another Facebook group, and somebody was saying, I mean, they're pretty stable and it looks like they're, have really good credit, that they got quoted on a conventional loan 5% for their loan. And then somebody had a commercial loan for a smaller property and they were being charged like 4.25. And so it's very interesting that, the conventional loan seems to be like creeping up, going higher, and the commercial loans are, like not like also around the same rate.
Well, typically on a bank loan, that's going to be from their depositors. They're going to be paying the interest to their depositors. So it's not based on the 10-year treasury. So they are using, their what is the bank lending index, and that's going to be different on bank lending always. I mean, even banks that I'm working with on a commercial side, they're usually 5-year loans at 20 to 25 amortization as opposed to 30. So they use a little bit different. Some of them use their balance sheet lenders, so they have a different method to figuring out their interest rates and their spreads. But yeah, I would say on a whole, things are they're moving, they're shifting. Is it in an upward trend? I think so. I think we're going to see this slowly up and down, but I think the trend will be consistent, picking up a couple bips, dropping 1, picking up 2, 1. It's going to be, I think that's how it's going to be. Now we're trying to keep inflation. Once we hit 2%, that's kind of the boiling point where we see inflation happening. And we're close to that. And it has been the Fed's real interest to keep it at 2. Once it goes above that, we're truly going to be seeing the effects with higher costs of food, of housing. You're going to need to be paid more for the inflation. I mean, so everything, the value of money changes with inflation. So it is in the best interest of the Feds to try and keep it as low as possible for now, so we don't have that impact on people that are unemployed, right, and are dealing with this COVID impact.
So it's still a good time to get in the game now, even though the rates are going up.
Every day is better than yesterday. So I think your biggest challenge right now is finding a deal. That is the biggest challenge. And the sooner you get connected to these communities, get connected to buyers and sellers, the sooner you can get into these deals. I would tell you that I would look at assets that you can take down. Again, as I mentioned, going for 1,000 units when you don't have any money, you have no net worth, and you don't have any liquidity, and you don't have any teammates is a big waste of your time and vendors' time. Look for things that you can take down with a little bit of help, whether that's $1 million or it's $10 million. Do something that works for your investors, for your pool of people. Anybody else?
Julie Anne, I'm kind of new to Old Capital, and I met you in a couple of the rooms, but my question is, what's the minimum loan size that you guys would prefer to do? And like, what's the minimum size you would do? And what is your preferred loan size? Like you're talking about 10 million, lending out 7.5 million. Is that like your preferred size? And then how low will you go?
So we'll go down, me personally, we'll go down, and I like to use like 500,000 if we're going to do a bridge loan, if there is a rehab component. It doesn't make a lot of sense, I'll be honest with you, to be doing a bank loan with like with us, because you're going to pay me 1% for that bank loan. You could have walked into a bank and gotten it by yourself, but let's say you do this, you have a full-time job. Don't call me when you want, and I'll take care of it, because that's what I do. But if this is something where you have time and energy to call and visit with these guys, because banking, local banks are they're difficult to deal with. You don't know what you're saying. They don't trust you. It's an uphill battle. So that's why we would help you, and we believe it's cost effective for you above $1 million, right? Again, if it's a bridge loan where we think, you do this rehab and we can get you into a permanent loan, then 500,000 makes sense. Yeah.
And then what is your preferred? Like if somebody walks in asking for $1 million, you might like, okay, fine, I'll do you a favor. But what's like an ideal for you? Like 7.5 million?
Yeah. You know what? I don't judge. I'm here to help. So if you need $1 million loan, I'm here to help. You need a 10 million, I'm here to help. Whether I do $1 million or I do 100 million, it's all the same effort. So if I were to say time for money is time, time is money, sure, I'd love to have 10, $20 million transactions. But I'm also here to tell you, and I think you and I have talked about this, is that I'm going to get in on your first deal and your second and your third, and I'm going to help you. And now you become my sponsor, where I can get you into a transaction with a new person. So now I'm helping you build your net worth and accelerate your wealth much quicker, right? So I'd like to have you from the smallest so that we can grow your business. That's where I come in. That's how I run my business.
Okay, great, thanks.
Sure. Hi, Esther.
Esther's real famous.
Oh, yeah.
Yeah.
And Vinky's in the house too.
Hi.
Hi.
Yeah. So, wow. So great presentation, Julie. I know that you are the hardest working woman in real estate, because I know that you did a podcast, and then you're gonna be on somebody's meetup tomorrow. So I'm just grateful to have you on here. To
My meetup.
to be.
Yep, I'm going to Vinky's.
Yep, she be on Vinky. So this is basically the Zoom at 8 baby right here. Me. So we started this because of Zoom at 8. So I'm just thankful for the creator of Zoom at 8 to be on here for her baby meetup right here.
Yeah, it is. As I cautioned Aaron, it's a lot of work. It's like putting on a wedding every week, but we have a great time, and we are, we've closed six deals out of Zoom at 8. So It's been great for my business. It's great for the relationships that are being created, and it's pretty special. So if you guys aren't connected, many of you are, come join us every Tuesday night at 8 o'clock Eastern. It gets a little late. We've gone now. Aaron has got us all involved with this after party. I'm
Yes.
thinking we just should have an after party just forget the beginning. Let's just all go to the after party. But you know, it goes on and on. But it's a lot of fun.
Where's the Zoom at 8 is great t-shirt, Julie?
I've got to get that. I made the "You're on mute" t-shirt,
Great.
and we're getting people. We're getting people to turn on, get off mute as quick as possible. So. Well, Mona, you came on to Zoom at 8. Now you're a regular. You come and go through there. Vinky, everybody. Ping, you're next. Michael's a regular. Corey, you're gonna come. Edmund, I don't know, Edmund, have you been on mine, or have I just been seeing you around town?
No, I'm slowly easing my way in. Aaron's been trying
Oh,
to
yeah.
get me in on everything, and he just like gave me a fire hose. I'm like, no, man, I got to ease into this.
Okay,
But
yeah.
like, I got to tell you, man, I haven't gone through so much derivatives and stuff. It just like blows my mind. I haven't gone so much through derivatives since I got licensed as a stockbroker decades ago. And it's like, you could be right on CNBC. That's great, man. I learned so much just tonight.
Oh, that's fantastic. I love that. Thank you. I appreciate that.
Let me say this something about Edmund right here. And he's gonna be a future guest. He's already scheduled for later on this year. But you know, when I met him, we had a great talk, and he had a great. All right, Kenneth. He had a great presentation on Brian Briscoe's meetup.
I saw that.
Yeah.
That's awesome.
And he was on a podcast as well. So
He
Brian,
just stepped in, and now he's going gangbusters.
hey, he's Mr. Canada right there. You know, he defend his country in Canada.
Amazing.
Yep.
Yeah. So look, all that saying, we're gonna go to what we call roll call before we go to breakout rooms. Roll call is when I think we have all basically everybody's been here before, but I still go down this list because I want to add value to people who are new and want to know more things. So I want to start with the military, ADPI. I talked to Tim Kelly today, and we're going to collab more with myself and ADPI, but great group of guys, Mike Foster and those guys have a great podcast. So if you guys want information about military affiliated, go to ADPI, great group of guys. Matter of fact, I think GOB Network and ADPI will be working together more in the future. Stay tuned for that. White Feathers, Greg Narrows, somebody who Julie just had on Zoom at 8 this past Tuesday.
Buddy Rushing.
Buddy Rushing. I was about Greg. Buddy Rushing.
That Greg Namro is his partner.
Right. So White Feathers is a great organization as well for military affiliated. Sever Figure Flipping with Bill Allen. If you guys don't know, they have a conference that me, Michael Barnhart, Kenneth, and others have attended last year. It's called REI Conference. It's May 1st, so next week. Very, very excited for that. That really took my career off the ground. I met Megan Greathouse, and that's how I got my my duplex here that I'm house hacking at. And then finally, me and Claudia are part of this group, the War Room Mastermind group. We meet every Sunday, but other groups meet all the time. But Bud Evans, Michael Barnhart, Marcus Long, so many others are part of the War Room Mastermind group. So if you guys want information, please hit me up or go to my go to my website. I'm sorry. For civilians, go to Bigger Pockets. Really self-explanatory. There's so much information. If you guys want to learn, go to biggerpockets.com. Let's see. And Ring. So Wholesale Real Estate Investment Group. I'm part of that group, and we have chapters in Washington State, LA, St. Louis, Fayetteville, New York City, Raleigh, North Carolina, and others. So if you guys want to learn about wholesaling real estate, please go to Ring or just contact me.